Welcome to Trader TV Equities, your insight into the trading climate for professional stock investors. I'm Dan Barnes. Event risk could be massive for any portfolio in 2019. In December's show, we're talking with Gianluca Minieri, Chief Executive Officer of Amundi Intermediation for UK and Ireland, and Tim McCourt, Global Head of Equity Index and Alternative Investment Products at CME Group, about the skills and tools that trading desks need to handle event risk in the stock markets. Gianluca, welcome back to Trader TV.
Thank you, Dan. It's nice to be back.
So in 2019, there are a number of big events which could potentially impact a portfolio. How are those events and the risks associated with them manifested on the trading desk?
When we ask if there's any event that is going to create risk for us in 2019, we're really asking to what extent this event will have an impact in terms of liquidity.
Yep.
And how are we going to manage them?
Absolutely. And when we talk about liquidity, often people talk about liquidity in the fixed income markets. How do you see that balancing out between equities and bonds?
The traditional classification of liquidity between equity and bond is not relevant anymore.
Okay.
I mean, if we look at liquidity, equity market are doing fine. I think in 2018, on a global scale, we have seen a reduction of the number of orders globally. But funny to say, the reduction has been experienced more than in US, where we didn't have the effect of any big regulation. While in Europe, the liquidity and equity market has actually improved in 2018. Fixed income is also, the liquidity in fixed income market is also at a quite good, reasonable level. Although maybe in European corporate bond market, trading in meaningful size can still be challenging.
Okay.
We think that a good classification in order to understand how liquidity is distributed across the asset classes is the difference between developed and emerging. Mm-hmm. In developed market, as I said, liquidity is doing fine. Emerging market, frontier market are a different story. The perception is that the liquidity resilience is very weak. And in case of fast market, in case of turbulence market, we feel that liquidity might be a challenge.
How might you use non-cash instruments to manage event risk of the sort we're going to see next year? And how does that affect the risk profile of the portfolio? Yeah.
Today, the use of non-cash instruments is stimulated by the liquidity, or the lack of, I should say,
yes.
Because readjustment, rebalancing of the portfolio are very costly if they have to be done using your cash, using your holdings, the holdings you have in your portfolio. So especially if this type of rebalancing are not strategic, but maybe a little bit more tactical than strategic, then the portfolio manager are much more keen to use derivatives because they are quick, they are liquid, and they can be more effective in terms of taking a view on a specific risk or on a specific bucket of a curve if it's an interest rate portfolio. And last but not least, I think derivatives are also much more used today for the typical use, they were born for, so to hedge specific risk in their portfolio. Very often portfolio managers see derivatives as a very cheap way of optimizing their portfolio, but this is because they do not see a lot of other costs that might be involved in when trading a derivative.
Yeah.
I would mention the clearing cost, but also the necessity of exchanging collateral, having a collateral management team, the reconciliation team. So from a company perspective, as a CEO of a company, I would look at derivatives in a much more strategic way. So you need to ensure that when all costs are added up, it still makes sense to use derivatives instead of cash instruments.
If you look at the predictions of market activity for 2019, we're seeing predictions of volatility, and there are certain known events. How would you characterize the effect this might have on trading for a buy-side firm?
Investors are asking to their investment managers to be able to navigate safely through this challenging environment. In a market environment where investment opportunities are scarce, in a market environment where carry trades are shrinking, I think we need to start looking at volatility as a source of alpha, rather than just as a risk to hedge. I think in 2019, investment managers shall concentrate more in creating those type of market neutral strategy that can generate returns in flat market, while maybe at the same time hedging from extreme risk. So the type of overlay strategy, being a professional seller of volatility, can be probably a successful strategy in 2019.
Gianluca, thank you very much for your time.
Thank you very much, Dan.
Now we're going to speak with Tim McCourt, Global Head of Equity Index and Alternative Investment Products at CME Group, about the potential to use derivatives to better manage event risk in 2019's equity markets. Tim, welcome to Trader TV.
Great, thanks for having me. Glad to be here.
Can you tell us how might event risk affect activity in the derivatives market over the coming year?
Well, I think it's hard to forecast the exact impact of any one specific event or a series of events in the market. But if we look at 2018, where we saw the return of volatility to the global equity markets, we can be certain that this is going to continue into 2019 in some form or fashion. When looking at how these events may impact a customer's investment or trading decision, I think it's important to note that these events are no longer comporting to a standard Monday through Friday 9 to 5 news cycle. We're really seeing market moving events happen all throughout the day, all throughout the evening. And this is a benefit that CME provides by providing near 24-hour access to our futures and options on futures market, such that when these market moves occur, customers can turn to CME to manage their risk or to implement the trading strategies they've decided with respect to their global equity index exposure.
How do you see the use of non-cash instruments changing amongst buy-side firms?
I think what's interesting when we're looking at buy-side firms and their use of non-cash instruments such as futures or options at futures available here at CME, their use case has evolved over time. Typically or traditionally, the buy side has used futures as a way to access their global equity index exposure from a portfolio replication perspective, or implementing beta, or looking at equitizing their portfolio. But with some of the products brought to market at CME, we're looking to evolve that transactional handshake that the buy-side customer uses such that they can more precisely manage their global equity index exposure. Some of those things that we've seen the adoption of from the buy side are things such as BTIC, or Basis Trade Index at Close, or TACO, Trade at Cash Open, which allow market participants to trade futures in basis form against the equity index they're benchmarked to. Those are things that we've seen market participants use in terms of managing their risk, as well as the continued use of using the liquidity and the robustness of CME Group equity index futures in managing their core equity index exposure across the globe.
And what are the advantages of using listed derivatives over over-the-counter derivatives?
What's interesting is over the past few years, we've seen customers across the various market segments look to and turn to listed derivative in lieu of OTC products because of the capital efficiencies afforded by centrally cleared futures and options on futures at CME. For example, if we look at just some of the U.S. equity index exposure and the impact of uncleared margin rules, there's been an undoubted tailwind to futures, specifically our total return futures that we've introduced at CME in this regard. The margin efficiencies and the capital efficiencies that futures provide are far superior to than what's available in the OTC market, or what market participants may be subjected to as a result of some of the things such as uncleared margin rules, which introduce a 15% initial margin requirement on uncleared equity index swaps, or some of the Basel-related line item charges such as on options portfolio or RWA charges that are being passed on to market participants because of the capital required being set aside. So when we look at centrally cleared products such as futures or options at futures at CME, these are a great way for clients to either directly or indirectly access the benefits because they are trading directly at the exchange, or by quoting products that are centrally cleared at CME through their dealers, they will enjoy some of the savings that the dealers have as well in terms of the price being quoted to them by being more efficient at CME through options on futures and futures.
And how would you characterize the impact that employing futures and options can have upon the trading and investment process overall?
When looking at the impact that using futures or options on futures could have on one's portfolio or the impact on investing, I think it's important to keep in mind things as capital efficiencies or margin efficiencies that can be afforded to a participant by trading and managing their global equity index exposure at one exchange and one clearinghouse here at CME. But when we look at the ability to deploy more tactical strategies, I think one of the advantages that futures and options on futures afford customers beyond the capital savings is the ability to be more precise with their risk management when they need it. When we look at some of these global equity trends that are happening in 2018 and expected to continue into 2019, customers may need to more precisely manage their risk, or they may want to deploy certain things, whether it be sector rotation or how they equitize their portfolio, or simply how they manage their cash to operate their funds or their strategy. These are benefits that futures can provide by tapping into the near 24-hour liquidity at CME, as well as the low total cost in terms of implementing their global equity index strategies through futures and options on futures at CME. And these are just some of the impacts, and it's something where we've seen continued increase of activity across all customer segments in 2018, and with continued product innovation at CME, such as BTIC, basis traded index close, or total return futures, we're only increasing the opportunity for customers to use more capital efficient tools at CME Group when managing their global equity index exposure.
That's great. Tim, thank you very much.
My pleasure.
I'd like to thank Gianluca Minieri of Amundi Intermediation and Tim McCourt of CME Group for their insights into equity markets in 2019, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.